So as we turn to some of the leading indicators, it's good to understand where were we and how are things changing going forward. And when you just look at the GDP side, you can see consumer spending slowed, still positive. That's still a positive move in general. But the exports was a big driver, and a lot of that was driven on the back of higher dollar price, higher dollar strength, and enabling us to increase the value of our exports, and then obviously our imports get cheaper. So some of that is one-off, as all of that is more of a mathematical calculation that catches up in Q4. Change in private inventories, again, kind of fluctuating a bit, but that's where we continue to see some of these shifts. But the residential, that investment had a big drop in general. When you look at some of the mathematics behind it, we think non-residential stays fairly flat. But when you look at some of the key pieces, the one obviously to watch is going to be consumer spending, but you're going to lose the uplift in near term realistically from exports as well as inventories, and the export side specifically, especially as we talked in segment 2 on how we're seeing a drop in new export orders. And a lot of those key dynamics when you look at where exports are going and how those are going to continue to come down. Then when you look at, aside from the pandemic, just reiterating a piece from before, the real final sales with private domestic purchasers, which is the core GDP, were the weakest since the fourth quarter of 2009. And that's, again, a very negative driver going forward. 6 straight quarters of declining residential investment, longest streak since the great financial crisis, and before that, the longest since early 1980s. So key pieces of the economy are giving you some of those concerns. And then when you look at the leading indicators of those, they continue to show the problems that we've been highlighting and why we think it continues to get worse. Underlying piece is the real disposable personal income per capita has come down. You can see that we're back to where we were in 2019. And then real disposable personal income continues to waffle along that pre-pandemic level, which again is, when you think about that on the real disposable side, that's where, again, you're seeing some of those pressure points. And then when you factor in that shrinkflation, which sometimes the real data doesn't really pick up on, you can see that things have gotten a bit worse. And we're going to show some of the shifts between savings rates as well as credit card debt, and how that is exacerbating the issues, which is only getting stressed further with rates moving higher. Wage growth has begun to roll over, and the biggest problem with that is wages are rolling over as you're actually getting either a renewed acceleration in inflation, or at least a lot of staying power in current pricing regimes, which is why as wages come down, that's only going to put more stress on real disposable income, real purchases. And then when you look at the wage survey measure, Atlanta Fed growth, you can see all of it moving to the downside. And this would be okay if inflation was also rolling to the downside, but we're not getting that. We're getting inflation that's either flat to up as wages roll down, creating underlying additional pressure points. Ever so slightly, real personal income, excluding government transfer payments, made a new high in September. But when you look at some of those different pieces, again, you're seeing some of that where now, as we talked about in segment 2, you're getting a bit of a rollover in wage expense, wage cost, which comes down to what people are earning, because you're the expense. And if that's going down, it means you're going to make less going forward. And that's underlying pressure points, as you can see here with slower decline for transfer payments, weight and personal income, 17.3%, down significantly from the pandemic peak in the 30% range, but still higher than it was in pre-pandemic. But a lot of those transfers are continuing to whittle down. Personal savings rates tick down in September to 3.1%. And again, that cushion continues to evaporate as rates hover near the lowest since the great financial crisis. And again, you're just seeing people don't have the ability to put more and more money away for savings. And I can speak from personal experience as I've been trying to build this business between PVN, between the private equity fund. I mean, anything I'm able to scrimp together goes right back out in terms of cost, and I haven't been able to save anything. And I like to think I'm in a higher echelon, a higher bracket in terms of income capacity, and it just isn't possible. I have costs in terms of business formation, but then also healthcare, food, childcare, all of these things continue to go up, keeping things hindered. So then when you look at in year-over-year terms, on the existing home sale side, you're not yet seeing material weakness in existing home price growth, 8.4% rate as of September. So it's well off of the double-digit peak, but it's still getting weaker. And the problem is it's getting weaker, but it's still positive. And that's why we still have so much additional pain in terms of the housing market that has yet to completely come through. And all of this comes back down to the 10-year bond yield versus the housing market. And the question is, are we going to be able to see the 10-year bond outperform on a yield basis versus the housing market? And I think the answer is yes. Not because of the economic backdrop of it, but more just on the underlying trade flows of just the amount of 10-year bond paper in the market and the underlying buyers. And simply put, there are more sellers than buyers. And in order to incentivize more buying, you have to push rates higher to bring them in, which is why when you look at the yield curve, the belly of the curve, let's call it that 7 to 20 year piece or 7 to 10 year piece, if you want to go down to 5 to 10, is very confused. And if you were to show that to someone and say, we're in a bull market, they'd look at that and be like, oh, I can see that. And then you could show it and say, well, we're in a bear market. They could look at the curve and say, yeah, I could see that, because it's so inconsistent and uncertain, where any move could be a steepener or a bull decline. And so you could have a bear steepener, which is the front month, the short duration gets cheaper than the long dated. And then you could have a bull steepener where the opposite happens. And it's just the belly of the curve is very confused. And that's why I think there is a lot of that in terms of the dynamics of flows. Change in personal consumption, the frustratingly slow easing of core PCE sequentially momentum, but pace of slowdown is not really going to accelerate. PCE prices came in at 0.3% month over month. It's growing at a slower rate, but still growing, and it's driven by services, which were up 0.6%. Services are stickier in terms of price appreciation than goods, and that's the bigger issue on why we've been talking so much about sticky inflation, core inflation, median, mean, trimmed mean. All of these things are highlighting the problems. Core PCE prices came in at 0.5%, easing, but still very much elevated. And again, just rising at a slower rate, but still positive, as you can see from this underlying chart. So you take that in general and you look at the headline personal consumption expenditures, PC inflation steady at an elevated 6.2% year on year, near a 4-decade high, while core PCI inflation firmed more at 0.2% to 5.1%. So again, we're not seeing the plateau on the core side, and we don't see that happening this year, just given the pricing dynamics that have to happen to bring in and move things up to essentially a mark to market when we look at the different fundamentals of both housing and other. U.S. personal savings near historic bottoms, while credit card loans are at an all-time high and going higher. Now, at some point, right now, everybody is living off of either what's in savings and credit cards. And that is not a sustainable move, but the problem is, when does the consumer give it up? And that is an unknown. I put a stake in the ground and said it was in October of this year. We will see if I am right. But all of the data, as I've tried to explain it to you and show you, the data sets that I look at are showing that that should be the case. Growth in inventories when you're looking at the market in general. So inventory for on sale and rental market is exploding at the same time, which is called a double housing crash, where there's a simultaneous collapse in buyer and renter demand. Real estate investors are panicking because when we showed some charts a couple months ago, how people who were building homes, instead of selling them into the market, said, I'm going to turn these to rent. But the rental market's like, okay, you can do that, but nobody's here to rent that. So now you can't sell it into the market because there's no buyer, and now you can't rent it. And that's where you're getting a lot of volume coming to market without any real buyers, which is going to bring that price down. And you're seeing it again with MBA purchase index. And that's just looking at the mortgages that are out there is at a 2014 level. So you're looking at a multi-year low in terms of new mortgages, showing that there is no appetite right now in the housing world. U.S. pending home sales, confirming what we just said. Pending home sales fell by more than 30% year on year in September. Only one other month during which sales fell at a faster rate, which was April 2020. So again, not a great month to be compared to when you look at just the underlying pain. And that's where we see that acceleration, and that's where you're getting more and more inventory left on the market. Taking that to the next level, September pending home sales came in at negative 10.2% versus 4% estimate. Worst monthly drop since April 2020, bringing the level down again closer to the COVID low. But then when you look at other points in time, it's similar to 2008 and 2010, which were, again, two places that are not a very good place to compare yourself to when you're looking at underlying market strength. Personal income, coming back to this, personal income came in at 0.4% versus the estimate of 0.4%. Personal spending came in at 0.6 versus the estimate of 0.4. Still that positive move. But then as we showed in segment 2, when you adjust this for real income, you're seeing some of the disconnect. It's still positive, but that's the rollover that we're calling for because this was in September, and we see it going negative in October. PC inflation came in at 6.2% versus the estimate of 6.3%, while core came in at hotter at 5.1% versus the estimate of 5.2%. But again, the prior was 4.9%. So you're still seeing some of those increases, while PC inflation top line just held firm at last month's 6.2%. Showing, again, a lot of that staying power of inflation reaccelerating and stagflation hanging in. When you look at some of the results, consumer spending expectations over the next 3-month period, when you look at it, they're expecting to spend more they spent more in the last 3 months, and that's when you start looking at where things are shifting. Because consumer spending expectations over the next 3-month period, in the next 3 months, how much money do you expect to spend on groceries? More. When you look at online shopping, so people are either trying to stay the same, but as prices go up, the ability to stay the same gets harder and harder, and you're starting to see some of the non-core goods falling by the wayside in terms of deliveries, sporting goods, different apparel. And that's something that's going to put more pressure. But then when you look at U.S. private construction spending, residential rolled over a bit. Non-residential is where we see some of that staying power. But if you look at just residential, there is a very long way to go to come back to some of that normalcy, because typically they can deviate between non-residential and residential, but not that long and not that far in terms of that alligator mouth. So we do expect that snapback. When you look at Americans' estimate for Christmas spending, latest poll shows Americans estimate they'll spend on average $932 for Christmas gifts, up from the pandemic low of $805 and almost back to pre-pandemic high. But inflation plays a huge role. It's still worth noting that the spending intentions have rebounded. But as someone who has children, you want to try to give your children the same amount of presents, because kids understand volume, not value. So you're like, all right, well, how can I try to keep their presents at 5 or 10 or 15, however many you buy normally, and it's going to cost more, but it's just keeping things the same. And that's the struggle that we're going to have as that inflation really starts to bite. Retail sales versus inventory ratio continues to cool, have now fallen to the lowest since February 2021. Sharp improvement and reversal from last year's issue of we'll have to check back in. So again, you're starting to see some of those adjustments as we continue to see the supply chains catch up. Personal savings rates, as we've talked about, it's at a level of that stress, which is why when you start looking at Christmas savings, just to reiterate this chart specifically, when you factor in Christmas, when you factor in spending, this is going to eat into how long they can stay. And if people are able to eke out a normal Christmas, I would expect a very bad Q1 of 2023, because that's when you'll see a lot of that catch up. Another weak PMI. When you look at Kansas City Fed, index down to -7 versus the estimate of -2. Production and shipments and new orders all deeply negative. Again, new orders popping up again. Average work week fell back into contraction. Prices eased, but still expanding. Again, another issue. So you have inflation while economic growth is reduced. Then when you look at, again, new orders, -16, firmly in the red. Expected new orders, firmly negative, and you could see that they were positive, and you're getting that catch up, which is exactly what we called for based on what we saw with new orders. Backlog of orders also dropping. Outlook for new orders within the Dallas Fed firmly in recessionary territory, showing similar to what we saw in Kansas City, in Chicago. All of these things are showing those problems that are only getting worse and manifesting more so in this market. While Kansas City Fed, you can see prices paid came down, but still expanded. Prices received came down, still expanded. So even as you're getting the economic growth diminishing, you're still getting that inflationary pressure in the region. ISM Milwaukee fully in contraction at 45.2. Dallas Fed manufacturing new orders -8.8. So again, no matter where you're looking on a regional basis, everything is now in firmly negative territory for October, which is why we're coming out and saying that October is the pivot month for the consumer and for the underlying market in general. Dallas manufacturing expected production expanding, but still moving down. Expected new orders firmly negative at -4.5, which we think again speaks to where expected production is going to go, and we do expect it to go negative. While Dallas manufacturing prices paid coming down, but again still expanding on the inflationary side. All of this is showing that stagflation that we've been highlighting. Dallas manufacturing employment forecast, so higher expectations within Dallas Fed have rolled over significantly. Same pattern when you look at it in general. So when you look at manufacturing outlook, -0.1, and that's going to pull down that employment side because you're not going to need the same amount of people if you're not producing as much. When you look at swing and a miss for October, down to -19.4 versus the estimate of -18.5. New orders, as we showed before, fell deeper into contraction. Shipments, inventory, and work week fell into contraction. Employment ticked up since July, but the 6-month company outlook deeper into contraction. Again, just echoing all of the things that we've seen. Outlook for new orders, as you can see here, moving firmly negative, now hovering near the lowest since the pandemic started and consistent with levels last seen since the great financial crisis. September durable goods came in at 0.4 versus the estimate of 0.6. So again, that plateau that we're seeing, but this is September, and based on every regional data we've talked about, we do expect this to roll over in general. U.S. durable orders ex transportation, as you can see, was expected to be at 0.2, came in at -0.5. Capital goods orders non-defense was expected at 0.3, came in at -0.7. So when you look at some of the inner workings of the data, you're seeing, again, showing that depression and showing the contraction is accelerating. Then when you look at capital good orders versus real capital goods, this is the disconnect. Because that huge alligator mouth is the bigger problem when you look at the real data. And now real capital is really starting to roll over, starting to see that acceleration to the downside. It's now fallen below pre-pandemic levels, and that's where we see more pressure, and that top line is going to depress faster. But the real capital data is showing where that pain sits. Now, rounding things out, when we look at the underlying housing market, largest drop in pending sales in the last 8 years. But then when you look at Redfin Home Buyer Demand Index, it's down 35% year over year. And that's something that we continue to see, expect to see, as when you look at mortgage rates moving from 3% to 7% this year, boxes out 24 million households from a $400,000 mortgage. That means that the pool of potential buyers has shrunk by 47%, which again is the biggest issue when you look at who can actually afford a home now. And that this is showing you some of those answers. All the while, when you look at what is happening with the Fed, the balance sheet continues to be elevated, and the issues are happening, and we haven't even really seen a big QT, which is a bigger problem as we progress into the end of this year and into next year. So that's what we have for you on the U.S. In the next segment, we're going to go deeper into Europe and what is happening on the European front.